Welcome to Nothing Exempt. I am Nick Pardini, and I'm with my co-host Brian Piotr, and we're going to be bringing on a special guest today. His name is Christopher Irons, but he's more well known as being Quoth the Raven. He's a investigative research analyst who specializes in a lot of deep dive short selling ideas. He has a podcast known as the QTR podcast, and it's quite controversial, and a very interesting show about the various stocks that are going on in the market and some of the things in the economy. Before we get to talking to him, I just would like to mention a few things. Brian, what is the best way that people can find more about our show?
Well, if this is your first time listening and you want to reach out to us or give us feedback, the best place for that is really reddit.com on the subreddit Nothing Exempt, or reach out to us directly on Twitter. Our handle is Nothing Exempt. And if you want to email either of us, because you're old-fashioned, our emails are Brian, B-R-I-A-N, or Nick at nothingexempt.com.
Thanks. And the other thing, we'd like to mention, the show is brought to you by the Cause and Effect Report. The Cause and Effect Report is a macro research newsletter that specializes in using top-down themes to find single stock and option trading ideas. For more on that, you go to thecauseandeffectreport.com. And just as a note, nothing on this show or on the Cause and Effect Report is investment advice. You need to be doing your own due diligence and research.
And hey Nick, is there a way they can get a discount?
Yeah, you can type in the code Nothing Exempt in the coupon code section.
And that'll show the Cause and Effect Report that you came from here, and you'll help support the show.
Thanks for reminding me on that. And now with that, we'll get on with our interview.
You got involved in investigative research. So what are some of the sources that you use that are different from other analysts and traders? Because I kind of have a different approach to you to research. I kind of look at more what's going on from a top-down point of view by like reading like various news stories or certain feeds of things that come directly from governments or economic data, and then I make interpretations, figure out what that means for single stocks, whereas you go more deep dive, like from a bottom-up perspective, which it seems like it's a lot more difficult to get an edge that way, but if you do, it's a more sustainable edge. So how do you do that? Because it seems like in the era of, according to the efficient market hypothesis, which I don't really buy, that there shouldn't be hidden information. It should be reflected in the price of the stock. So how do you go about that?
Well, look, if I was going to short a name tomorrow, what I would do is the very first thing that I would do is I would read every SEC filing available on the company. So I would really, the nice thing about SEC filings, aside from the fact that they're boring and they're long and they, look like just a bunch of legal mumbo jumbo and they don't really look like a lot of fun to read. The nice thing about them is once you start to understand the functions of each filing, it can really help you get a lot of clarity on any given business. And SEC filings they work like a layered series of precedents, right? So the company's standing word is what it has said last on any given subject, whether it's guidance, whether it's the executive compensation of insiders, whether it's anything. So, a company is only as up to date as its last disclosure. And from reading through the progression of disclosures and comparing things like word changes in 10Qs and 10Ks and, differences that you find, additions and subtractions from things like risk factors, reading the management's discussion and analysis, reading press releases, reading conference call transcripts. When you take all of the stuff that is readily available, and I like SEC filings because they're the most objective for the most part out of all of the things that a company can offer. You'll probably get a little spin and a little bullshit on the conference call. You'll probably get a little spin and a little bullshit in the press release. You're going to get less of that in SEC filings because there is a mandated number of things that need to be covered, that need to be disclosed, in order for, a company to absolve itself from any liability.
Leads me to the next question, because I've read a lot of SEC filings myself, but when they release the earnings, the 10Q doesn't usually come out the same day as the earnings report. And so does the market really even factor in the differences that, say, if the 10Q says something material, but since earnings came out last week, it's just whatever?
Well, first off, look, if a company does that, that's just poor form to begin with, and that's something that you should note. There's been many instances where companies put out their earnings press release and they've waited on filing the 10Q, which is perfectly legal, and you're permitted to do that. I believe it's up to 3 business days before you have to file the 8K and the corresponding 10Q, whatever. But if you have a company that puts out an earnings report and it touts, a great profitable quarter, but a lot of it came from a one-time gain, and the company received a subpoena from the SEC over the previous quarter, and it didn't disclose that in the press release and just kind of led the public to believe that everything was fine until the 10Q dropped, that would be a huge red flag to me, not only in the fact that the SEC would be investigating the company or seeking documents from the company, but just that management is trying to kind of pull the wool over investors' eyes. So that's why I think the SEC filings are a really important place to start, because, again, the companies have to disclose anything and everything material to absolve themselves of any liability in the future that could wind up as, a breach of transparency or a breach of fiduciary duty or the securities fraud, or really withholding information, whatever the hell you want to call it. I don't know what the legal term is. But yeah, so I would start with those filings, and then from there, I would try to, once I have the whole company history down and I've read all of the conference call filings, all of the SEC filings, I would from there go and start trying to wedge my way into whatever the issue was that I was trying to figure out. So say I wanted to do an expose on Tesla's safety standards like Reveal did. I would go and I would start talking to ex-employees. So LinkedIn's a great place to start. A lot of short sellers go onto LinkedIn. They try to find ex-employees of the company to speak to them. It's not always people that left on bad terms. Sometimes people that leave companies on good terms will come back and will help you understand the business better or give you a little bit more insight. You have to be careful. Obviously, you don't want to have a breach of duty on either end. So if the company has a separation agreement with the employee or something like that, you have to be cognizant of those things and make sure that it's legal what you're doing. But a lot of times that can help out. A lot of times people that are experts in the industry can help out a lot. So if we wanted to go short, say we wanted to go short General Motors, maybe I would go and speak to somebody who was a former executive at Ford and ask them what they think about General Motors earnings, because they know the business really well. So they know where bullshit can kind of be tucked and where channels can be stuffed and where accounting adjustments can be made and things like that, especially if it's like an esoteric industry like insurance or something that's really difficult to kind of get your way through. So those are 2 really good places to start. And then, of course, when you conduct interviews like that, you want to make sure that the information that you're getting is vetted on your own as well, because you may find somebody with a bias that, just wants to get one over on the company or just wants to take you for a ride. So you have to go and try to vet everything that you find to the best of your ability. You could start there. I mean, lots of times these companies have LLCs and subsidiaries that they're associated with. You can go pull all the filings for those from the pertinent Secretary of State that the companies are incorporated in. A lot of times you can get a lot of information from those. You can find out who, the boards of directors are of those LLCs. You can look into the personal backgrounds of anybody and everybody. So if I'm looking at a company, I can go check out their board of directors and maybe try to do some type of background check on people that are on their board of directors and make sure that their background as it's disclosed in the proxy statement and their bio as it's disclosed by the company matches, truthfully. Make sure that companies aren't omitted from their background that may be worth looking into. My medics just did something like this where they brought on a guy who was previously stepped in as I believe, either CFO or on the board of Concordia right before it filed for their bankruptcy. And my medics brought on the same executive, ostensibly to kind of help them through this mess that they're in. And when they disclosed his biography, they didn't disclose the fact that he worked at Concordia. They probably thought, rightfully so, that the optics of it would be terrible because Concordia is a company that's now bankrupt. But even worse than that is now the fact that they didn't do it, and other people have pointed it out. So they look like even bigger dumbasses now for trying to pull one over the eyes of people. So those are some really good places to start. Another great place too, sorry, just stop me if I talk too much, but another great place too is the Wayback Machine on Google. You can go look at prior revisions of companies' websites. So a lot of times companies will omit and remit things to their website depending on situations and circumstances that are worth going and checking on. And just to go back to Carson and his TAL video, he did something similar where he went on the Wayback Machine and was comparing an old version of the company's website to what it looks like now. Just be a sleuth, man. The internet has made anything and everything that you could want widely available. So it's just a question of how much time you want to put into it and how voracious you want to be.
And Chris, can I ask you a question? Since you write for Seeking Alpha, a very well-known website, if you're writing an article every month or every day or regularly over a long period of time, eventually you're going to write something about somebody that someone doesn't like. And even if they have no legal basis, they could attempt to come shut you up. I'm not asking you if that's ever happened, but what would you do?
They can attempt to what?
Or how do you deal with something like that?
Well, they can sue you.
Oh, well, yeah. I mean, I'm being sued right now. So, I mean, that's commonplace. I mean, you look at Concordia as a great example. I mean, they went and sued Mark Cahotis, and then they filed for bankruptcy. I mean, look at my medics. I mean, they went out and sued a bunch of short sellers, and now they're restating 6 years of financial results. So a lot of times when a company doesn't have the truth on its side, it's one of their only options to defend themselves. If they can't come out and refute your facts, as a company, your options are kind of limited. So you have to posture up and try to do everything that you can. I mean, if I was working at a company and I knew that we were committing egregious fraud, and there were a bunch of short sellers out there that were just yapping about it, I mean, one way to try and get them to shut up about it would be to sue them. I mean, when you're a company and you have a lot of money, that acts as leverage, because if hopefully if you're an established short seller and you have your own firm, you have insurance. But if you don't have insurance and you're sued, it can be a very lengthy and very costly process. And many times it would be my guess that is the strategy of what these companies try to do that go after and sue short sellers. They don't have the facts to back themselves up, so they.
So how do you protect yourself as a writer on Seeking Alpha when you write about short positions? Well,
you have to. The very first thing is you want to make sure that absolutely anything and everything that you have is sourced. You want to make sure that everything is rooted in fact. You want to check and double check and triple check. You need to write the piece assuming that you're going to be sued and that you're going to need to defend every statement that you make in a court. So you need to look back at everything that you have written and make sure that you have something else that you can point back to and say, look, we got this from the annual report, or we got this from the conference call transcript, or whatever. We got this from our own internal analysis. You always want to make sure that you disclose any type of position that you have. You want to make sure that you are, you want to make sure that what you write is replete with qualifiers to let the reader know that, your analysis is an opinion, and it's your belief to the best of your understanding and to the best of your analytical skill. But that ultimately there is a margin for error, as there is with everything, whether it's a small margin for error or a large one, with any type of analysis. Even the best people occasionally make very small mistakes. But you just, like I said, you want to write it assuming that you're going to be sued, and that you're going to have to defend everything that you write. And you go back and read and reread and reread what you write over and over and over again, and then just make sure that the facts are there, because companies will know. I mean, they'll know if you – I'm guessing a lot of these companies know that they don't have a case when they sue people. But I don't know. I imagine, too, some of these companies probably do feel as though I don't know, maybe they feel as though they're being ganged up on or what. I'm not really sure. But as long as you have the facts on your side and really it's protected free speech. As long as you're not going out and knowingly putting out false information, even if you do get something wrong, if it's your sincere belief that it's accurate and that you can point to research that you've done to try and draw that conclusion, that also should be protected free speech. So, just like I said, write everything assuming you're going to be sued and you're going to have to defend it, and then hope you don't get sued.
Yeah. It kind of reminds me of the David Einhorn book, Fooling Some of the People All of the Time, and all of the battles that he had to go through. Like, were there any times that, other than like a lawsuit, where like a company has tried to like personally threaten you in any way?
I don't really remember being personally threatened, to be honest with you. It's not something I just don't spend a lot of time thinking about that. It's not really how I live. I don't know. Yeah, I can't really think of anything off the top of my head. I don't understand why a company would want to really waste their time with me, to be honest. But if they want to, that's their prerogative. I don't really know. I have a concealed carry permit. I sleep very well at night. I don't really worry too much about that, to be honest with you. What I would add is that if you're a short seller and you are sued and you believe that your case is right and you have the means and the resources and the capital to vigorously defend yourself, a lawsuit can sometimes work to your advantage. If it reaches a stage where you go through discovery, and you could essentially, request significant amounts of material through discovery to try and prove your case. So you may be able to get access to things through subpoena power in the case of a lawsuit that you wouldn't have access to normally. So it might work in your favor, and that's where, if a company was going to use legal options as their defense strategy, I would point out, I guess, that could be used against them as well. So, yeah. But no, I don't think I've been threatened, I think, more by people that are long companies that don't understand why I'm short them or why I'm critical of them. That's the most incendiary prescription of things. It's, one of my bosses always says, it's not going to be a guy that loses $1 million on a trade that shows up at my house and tries to kill me. It's going to be a guy that loses $100 but doesn't understand his investment, doesn't understand why the stock's going down. And I've gotten far more threats like that, on social media and things like that from people that I truly believe if they understood how the capital markets worked and they understood that the criticisms of whatever piece of shit company they're holding are not unfounded, and they took the time to look at things through that lens, they would get it. But a lot of times it's a dangerous combination. If you don't really understand how the market works and you're long something because of the story, and maybe you don't understand the financials, or maybe you're just in a cognitive dissonance mode where you're trying to justify your investment regardless and you don't really understand it, that's a really bad combination, and that can sometimes lead to, people saying nasty things. And, again, it's all, most of it's nonsense. I mean, I don't really pay too much attention to it.
So on the other side of things, what are you looking at on the long side? Like, what are some companies, because you're most famous for your shorts, such as Tesla and Herbalife and Mimetics, but what are some things that you, like, I always find it interesting for short sellers, since they are skeptical by nature and do a lot more due diligence often because of the risks. What are you looking at what do you look for a long, and what are some companies that you're looking for on the bull side right now?
You look for the opposite of what you look for in a short case, right? So when you're trying to identify a short candidate, you're trying to figure out that there is either a hidden liability or hidden red flags that the rest of the market doesn't understand and hasn't priced in. So as a short seller, you're trying to kind of look behind the curtain and see what's going on behind the scenes to some degree. Obviously, you're not looking for material non-public information, but you're looking to try and find little pieces of the information arbitrage that the rest of the market hasn't discovered. And when you can combine those types of things with a company that's already extremely overvalued, and you have the means to catalyze that and get the public to understand it, whether it's from writing a research report or sharing your research publicly, that's kind of what you would look for on the short side. On the long side, you're looking for just the opposite. You're looking for deep value, or you're looking for growth that is cheap. I'll give you two companies that I'm long right now. Fitbit, I've been long since $4.90 or $4.95 or $5. I can't really remember, but I've been long for some time. And Citron actually just put out a nice report on them going a long report. But, I mean, that was a case where sentiment was basically at an all-time low. The company was down 95%. Basically, everybody had written it off and assumed that it was going bankrupt. But when you looked at the balance sheet, it was a totally different story. I mean, they had over $1 billion in cash. They had no debt. They didn't have a, really materially negative cash burn. They have a new product that just came out that's selling exceptionally well. They have new partnerships with United Health and Google. And so the rumors of their death had kind of been greatly exaggerated. And that was a stock where really Wall Street said it was dead. But it wasn't. Just looking at the financials told you a different story. Another company I'm long is Costco. I mean, I've been long Costco for a long time. Costco isn't even a cheap stock either. It's always been trading at a multiple of, 25 or 30 times earnings, which for a retail company is pretty much unheard of right now. Retail stocks right now trade between, 6 times earnings and probably 18 times earnings on the upper echelon, but Costco is an exception. I think it's the best in retail. I think they have the best business model in brick and mortar. I think that they, their comps have been incredible. I'm a member. I love the business. So it's really all about trying to pick and choose areas where you're going to find value where the rest of the market doesn't see it. Or in the case of Costco, where you have to kind of pay up for shares. Now, I was buying, at 140 or 150. But even then you were paying up. It was 24 times earning or 25, and you got a little multiple expansion because comparables have still been incredible, and the company has bucked the retail trend significantly. So there it becomes a case where you even saw a little bit of multiple expansion, I think, and it's kind of worth paying up for a company in the retail sector, which would be really one of the last sectors you'd probably think would be worth paying up for. Yeah. Yeah, you look for the same thing, man. You look for pockets of information, and you try to find value or find, a case that the market hasn't identified yet. It's good. Like Fitbit is a great example because they had $3 and maybe $3.50 a share in cash. I forget what it was, but I like situations like that. Macy's a while back, trading at $18 or $19. Sitting on billions of dollars in real estate. Hard assets. Now they had a lot of debt too, but they still had some cash flow, and they were trading at a mid-single digit earnings multiple. An asset base like that, even with mall landlords, dropping like flies and with mall property decreasing in value significantly, I still like having those hard assets on the balance sheet. So I love companies that have something like that they can fall back on.
How much do you factor in top-down or macroeconomic factors to your analysis, if at all?
To be honest with you, I mean, it hasn't really mattered over the last 7 or 8 years. I'd love to tell you that, CPI in China overnight is going to make a difference on your holdings in Johnson & Johnson tomorrow, but it's not. And so because most of these numbers, I believe, are geared or made up or irrelevant, because the macroeconomic picture is such that there's so many variables and there's so much data, and it can all be tweaked and manipulated in so many ways that, the central banks want to manipulate it, that it doesn't really matter. And the whole kind of playing field that we're on, this stupid, dumbass, nonsensical policy where, we privatize profits and then we socialize losses, and the government comes in and bails out. The government comes in and bails out companies like General Motors or bails out the banks. I just think is ridiculous. So it's a completely rigged system. It's not free market capitalism. So it's impossible to try and kind of figure out how the macroeconomic picture is going to really impact individual equities. Now, of course, obviously, if Trump imposes a steel tariff, companies that purchase steel as part of their cost of goods will be impacted. So things like that you obviously have to take into account. But for the most part, I give it a look. I look it over. I make sure that there's no major macroeconomic or currency headwinds or anything like that. Other than that, it's really been difficult because the sentiment du jour for the last 8 years has been just buy whatever the fuck you can get your hands on, and it doesn't really matter. Buy all dips. It doesn't matter if the company makes a profit. It doesn't matter if they generate cash. It doesn't matter if their CEO comes out and lies and misses production targets. None of that shit matters. People don't care about it right now. And you're seeing that, like, even in today, where, we're big rally today in names like Tesla and Netflix, I said. And Netflix, great business, but when you look at them on like a cash flow multiple, it's insanely overvalued. And company like Tesla, everybody knows the story, right? They have negative operating leverage. The more that they produce, the less money they make. But then Einhorn goes out and shorts a bubble of these companies thinking, or a basket of these companies thinking, this is asinine and it's insane. And what happens? He gets his balls stomped in by the market. And that's a product of the overall rigged market. You should be fucking frightened when you look at a chart of the stock market and all it does is go up.
Well, I don't know
because
if you've
that's
seen
not a
this
market.
Quoth, but there is a statistic that Goldman released that basically over the last 30 days that the most shorted list has outperformed the top quality 50 in the S&P by 2-to-1 ratio for the month of June.
Yeah.
And I've noticed just with my own portfolio, a lot of the bad quality companies are getting squeezed up, and the good companies are not, except for maybe the FANGs, but have a valuation problem, but they're still fundamentally sound companies.
Well, you want to hope. You want to hope that in the future that maybe someday will eventually help create an opportunity to the short side if any type of reason makes its way back into the market. But Jesus, who knows, right? Like, who knows whether or not that'll happen, and who knows when it will happen if it does happen. The catalyst for something like that is nobody knows. Look, all I know is it will happen again. It's just a matter of time.
Yeah, I agree with you on that. And I thought that time was the beginning of this year, but it's too early to determine that. The next thing I want to ask you on a more lighter note is you're from Philadelphia.
Well, we need a real serious catalyst. We need something that the central banks and the government aren't going to be able to put a Band-Aid on overnight. And when that happens, then, shit will kind of get shaken up again. But until then, all of these little corrections that we've had, whether it was from Trump getting elected or whether it was from Brexit, the Brexit vote, the market crashed the next day and then came back up. The Chinese A-share market crashed, a year or two ago, and that pulled down markets and they came back up. I mean, the fucking market is being rigged, right? The Fed is stepping in, and in my opinion, it's my sincere belief that the Fed buys S&P futures. I can't prove that. That's an unfounded statement. But just through our monetary policy of printing money whenever we need it to bail out companies and spending from a position of a deficit and encouraging companies to run up debt and manipulating interest rates and keeping them low so that companies can take on debt to buy back their own, expensive stock, all we're doing is perpetuating a bubble. I mean, that's insane. That is absolute insanity. And it's great. It's euphoria now until it isn't. But we're going to need a catalyst that's going to make some people sweat. It needs to be something relatively serious. It's not going to be, General Electric restates their financials, and that's going to make the market turn.
Well, what do you think is more likely that catalyst? Italy, Tesla, or the pension system?
Oh, jeez. Those are three great choices. That's a great question. I mean, I guess out of the three, I would probably say the pension system, because when the pension system goes bust, it's going to start to fuck with, people's disposable income, and that'll start to tighten up spending. But again, the pension system is, and Tesla and Italy are all problems that the government can fix by printing money should they choose to. And I say fix as a double entendre, if you will, because they quote unquote fix it, but really it's a fix in and of itself. Look, I don't know, man. Morgan Stanley just put out a note 2 months ago asking if the Fed or if the government would bail out Tesla if it went bankrupt. So we are officially in like fucking Thunderdome, okay? The notion that the government would bail out a company that is so poorly performing as Tesla just because they do something that some people think is honorable and that some people think is a great thing, that the government would discretionarily step in and just bail this company out, this money-losing, cash-burning company, is insane. It just gives you some insight into the thought process of what people are thinking. The notion that an analyst for a major investment bank postulated that and actually asked it in relatively serious fashion is fucking frightening to me. Like, that is frightening. But that's the system we're in now. And who's to say that if the government bails out Tesla that they're not going to bail out, whatever,
you can rationalize is that pension accounts own Tesla and you need to keep the pension solvent. That's going to be the rationale to save any company.
But what everybody doesn't understand is even if the government, quote unquote, bails these companies out, they do it by increasing the money supply, by decreasing the purchasing power of the dollar, that eventually, a lot of this money winds up making its way into equity markets kind of as a shortstop, but it will lead to quicker inflation, prices rising ahead of wage inflation, which means things normalized will be more expensive for the consumer. It's a tax on people that people don't understand.
The thing I would like to ask is that this is something I've watched over the last 7 years, that some of the best performing stocks are companies like Netflix, Microsoft, which makes an Xbox, Electronic Arts, Activision, Domino's Pizza, Facebook. The one thing in common with a lot of these top performers is that they are cheap entertainment for the masses without like an income to spend on bigger purchases. So if you really think that like the concentration of these FANG and other cheap entertainment style companies, mainly in gaming and fast food and that type of variety. Is that really the market telling us that standard of
Well,
living is falling?
no, I don't think so. I would disagree with that. I don't think that. I think that your data set is too small to kind of make that assumption. And I think that the companies that you brought up are too different in nature to kind of group them all together. I mean, Facebook is a company that the masses use, but really it's an advertising company is really what it is. It generates cash from advertisements. It doesn't, I guess by way of consumers viewing the website, but really they're an advertising company. And Domino's is really, they're a pizza company, and Electronic Arts is a software company really at its core. And Microsoft does a lot more than just produce Xbox. I mean, Xbox is a relatively small segment of Microsoft. So what I would say is if you look at a company like Domino's, which, I just think is a pile of shit. Personally, that's just my economic analysis for you there, my personal opinion. Here you have a company that's trading at 30 times earnings or 26 or 27 times earnings, has been aggressively levering its balance sheet over the last couple of years to buy back its own stock, near 30 times earnings, is taking on significant levels of debt, and it, has gone up something like 30 times or 40 times since 2008, 2009, and is now being pitched on Mad Money by Jim Cramer as a technology company. I mean, this just shows you how everybody has gone mad. Everybody has lost their minds. I mean, the notion that there is a guy, the fact that there is a guy on CNBC who is like, quote unquote, the everyday, analyst that's going to help out the retail investor, and that this fucking guy is on television telling people to buy Domino's, which again is has a lot of debt maturing over the next couple of years in a rising interest rate environment, has benefited from a lot of tailwinds, commodity costs, low interest rates, is aggressively valued and aggressively priced near 30 times earnings. To go out and make that bullshit excuse for people to go and buy this stock right now, I think is indicative of the climate of the market right now, which is just nonsense. I would much rather own a company like a Facebook, which is, look, for all of the bad things that have happened with Facebook over the last year with the Cambridge Analytica scandal and, the privacy data and all this nonsense. It's a cash-generating behemoth. It's still growing significantly. It could have some runway to grow depending on how much it wants to rip off Snapchat and its competitors going forward. The Instagram, I think, is saving its ass right now. I'd much rather own like a Facebook or own a Microsoft than go out and own a company like Domino's Pizza. Even Electronic Arts, I mean, I don't know anything about it. I don't know how it's valued, but they have I'm assuming that a lot of
the tech companies. It's got good earnings growth, and it's profitable and generates cash, but its valuation is somewhat high. I have no position in it.
They have a good model though, right? They have all of these brands. Like every year, I go out and I buy Madden and I buy FIFA, right? So, and I know that there's a whole other suite of software products that people, including like RPG games and stuff, that people go out and they're constantly buying, and it's this kind of recurring stream of revenue. Now, I don't know if the stock's expensive or not, but on its face, just by understanding what the business does, I would rather own a company like an Electronic Arts than own Domino's here where it is. But I mean, that's just me.
Hey, Brian, I have one final lighter note question, but before I ask that, do you have anything else to ask?
Oh, I just wanted to throw in there that maybe we should create an ETF called Kramer, and all it does is short the stocks that Kramer picks. And I think that would be a pretty funny ETF. I don't know how it would proceed, but I think you'd have better luck shorting Dennis Gartman's longs, number one, because Kramer, I think, he does recommend some quality companies, and look, I'm sure there's a lot of names that he's recommended that have done well. The rising tide lifts all boats, right? So the market has done very well, and I'm sure that there's shit that he recommended 5 years ago that I would have told you was overvalued piles of shit that have done well over the last 5 years. And,
he knows what he's talking about, Kramer. He understands how to value companies. I mean, he understands what he's doing. So I'm sure that there's some stuff that nobody really has a talent for picking crap, though, like Dennis Gartman. I mean, he has really refined his technique for going out and specifically getting long names that are like going to go down imminently or are just on their face, companies with glaring red flags like Riot Blockchain. Now, I don't want to talk shit on anybody. And Dennis Gartman, I'm sure, has throughout the course of his career been wildly far more successful than I have. With that being said, I'd rather own an inverse Gartman ETF than an inverse Kramer ETF, even though I wouldn't buy a fucking pack of gum from either one of them.
Well, with Gartman, like, how much of it has become a self-fulfilling prophecy? Because every time he makes a call, it shows up on Zero Hedge, and people feel baited to take the other side.
I don't think it is a self-fulfilling prophecy, because a lot of the securities that he transacts in are not, they're ultra liquid and they're massive markets. So nobody is going out and selling treasury bonds because Zero Hedge posted an article that Gartman's long treasuries. I mean, he deals in commodities. He deals in, bonds, these super liquid instruments with, hundreds of billions of dollars or trillions of dollars in liquidity. So I don't buy that for a second. I just think the guy's just a fucking mess. I mean, I don't know what to tell you. I'm sure he's a great guy. Let me just say, I'm sure he's a lovely guy. I'd love to have a beer with him or a coffee with him, and I'm sure there's a lot I could learn from him. With that being said, I don't want him managing my money.
Yeah, then that last question I have before we conclude the show is, you're from Philadelphia, and I lived there for 1 year during graduate school, and I'm currently now in California, and our co-host lives in Aurora, Colorado. I want you to make the long case for the city of Philadelphia, which has a lot of criticism from other parts of the country.
Well, I used to think that Philadelphia, so I've always loved Philly. And ever since I've lived in Philly probably 16 years off and on in various parts and in the suburbs and things like that. And I always thought that once I got out and I traveled more, that I was nervous because I loved Philly so much, and I was always nervous that once I went out and saw more of the world that I would eventually not want to come back to Philly. And I didn't like that feeling because I really loved the city, and I was certain that I liked it. I liked the people, I liked the attitude, I liked the size. Everything about it just felt like home. And, when I was in my late teens, early 20s, I started to travel a lot more, and I started to go out and, I've been to a lot of really nice places domestically, been to San Francisco, I've been to Vegas, I've been to Florida, I've been to Kentucky, I've been to Maine, I've been, you name it, I've been everywhere domestically, internationally, I've been to whatever, I've been to Italy, I've been to Canada, I've been, so you go to all these different places, and I don't know, for me, Philly has always kind of felt like home. It's just the right size, and it might not be for everybody, man. There's some people that woman I was talking to last night was telling me that she loved New York City. She loved New York City. She liked it so much more than Philadelphia. She loved the pace, this, that, and the other thing. And for me, I can't stand New York City. Like, I loathe it. I just, and it's crazy because you think, you're a city person, so if you like Philadelphia, you'll love New York, or you'll love, Chicago or whatever. But a place like New York, too crowded, too many people, too much going on. Like, this is why I wouldn't want to live in like Beijing or like, Tokyo or somewhere where people are just shoulder to shoulder all the time. Philadelphia, you just get the best of all worlds. You get a good-sized city with a lot of diversity and a lot of neighborhoods. So there's different sections of the city for different personality types. There's public transportation that will get you anywhere. The people are relatively nice. There's a great beer scene. There's a great food scene. There's a lot of history if you're a history buff. There's a lot of sights to see. There's a beautiful art museum. There's Fairmount Park, which is a great place to, the whole basically northwest portion of the city is a giant park. And it has something for everybody. And at the end of the day, it's not too expensive. So it's not like New York City where, you go get a cup of coffee and it's $10. It's reasonably priced, so you can live there. The city tax isn't egregious. You don't have to sit like at the fucking Lincoln Tunnel every time you want to go home and then pay somebody $12 every time you want to go into Manhattan for the glorious luxury of driving through the Lincoln Tunnel to get into Manhattan, where you are promptly accosted by somebody who wants to wipe your windshield and a horse in front of you that doesn't have a shit bag on it is just leaving crap all over Fifth Avenue or whatever. It's not super crowded and it's not too small. And I don't know, for me, just the attitude and the feel and the flow of the city, the ebb and the flow of the city just matches my personality perfectly. So
yeah, it definitely seems that way based on my experience out in Philly. And thank you for appearing on a show with us today. Just before we end, I'd just like to make a disclaimer that nothing on this show is investment advice, and everything that we've said has come from public information, and you should contact your own investment advisor before doing any sort of trades, and do your own homework and do your own due diligence.
That's a great disclaimer. Do your research elsewhere is what I always say on my podcast. Don't listen to me, please.
And all the opinions of Quoth are his, all the opinions of mine are mine, and all the opinions of Brian's are Brian's. So that's all we're going to have to say on that. And we appreciate you coming and joining us on the show. And we may have you on again once the Tesla story kind of concludes one way or the other.
I would love to come on. What's that?
And I just want to say, and if listeners are listening to this, want to find you, where should they go? Where can they read you, and where can they listen to you?
On Twitter, I'm at Quoth the Raven, at QUOTHTHERAVEN, at Quoth the Raven on Twitter, and my website is quoththeravenresearch.com, and my podcast and all that shit's on there. You can find me. If you want to find me, you'll find me.
All right, that will conclude this show.